Welcome, everybody, and thank you for joining us for SBSB's Year-End Tax and Financial Planning segment, where we're going to discuss a variety of techniques to help you with your tax and planning needs for the balance of the year. I'm joined here today by Dave Merrill, our Director of Tax.
Hi, Karen. Hi, everybody. It feels so funny to be saying year-end tax planning, and here it is just in September. This has been such a strange year.
And just like we wrote in our newsletter, Dave, it's kind of like Christmas in July, but Christmas in September.
So. little present for you.
That's right, that's right. And so I'd like to start with a quote here, since we are talking about planning and bringing things forward. Planning is bringing the future into the present so that you can do something about it now. Author Alan Lankin said this a number of years ago, and I think it's relevant in so many scenarios, but especially this year in what has become a very unique 2020. Some of the discussion points we're going to address today really hit on some of the key elements of the Tax Cuts and Jobs Act, the Secure Act, and the CARES Act. Some of these items you've read about throughout the year as we've published different newsletters to kind of help aid you in certain decisions along the way. We're also going to discuss the impact on portfolio planning and retirement planning ideas that are still available throughout the rest of the year. We're also going to talk about some gift and estate planning scenarios to help manage capital gains and exemptions. And then charitable planning, not to be excluded, but we have some unique ideas for charitable planning for this year. And then we would be remiss to not address the big elephant in the room, and that is the election. And so we want to just talk through some of the ideas that are being proposed, reminding everybody that they are just proposals, but what kinds of impacts we can expect should some or all of these ideas be passed into legislation.
Now, some of these items aren't new, Karen. Some retirement planning, charitable giving has been around for a long time, but it seems like every year there's different opportunities, and as we're in a different economic environment, political environment, et cetera. And the different acts that we're going to talk through, the Tax Cuts and Jobs Act was passed at the end of 2017 and was effective in 2018 and 2019. So that's not new, but it still feels a little bit like a new discussion, especially in light of recent events this year.
That's right, and of course it was passed in 2017, and it has elements of it that have expiration dates that come about. So if we're looking here in this particular slide, we have additional deductions and a small window of time left for lower income tax rates and increased estate and gift tax exemptions. We all probably have heard this 11.5 roughly million floating around that is an estate exemption, and that exemption goes away, that sunset date, on December 31st of 2025. And then what that means is that amount then looks back to what the laws were in place in 2017. And we'll get into what those exact numbers are later during the program. The Secure Act of 2019, this actually was pretty critical in that it helped move the required beginning date, if you recall, was 70.5, to have to start to take your IRA and 401k distributions out of those plans. Now you can hold off until you're 72. So it helps manage kind of income tax bracket and cash flow needs relevant to that time in your life.
And the Secure Act was passed at the very beginning of 2020, very end of 2019, before any coronavirus things. And as is mentioned, addressed mostly retirement plans and made a few changes, few tweaks. One of the two that we talk about the most are listed here. And we really just started digging into the law in January, February, and hadn't gotten very far in the planning aspects of what to do about the Secure Act when coronavirus came on. And so that's not something that we've talked a lot about this year, is the changes the Secure Act brought about.
That's right. One of the interesting changes that's less to do with distributions from retirement plans, but how you bequeath those to family members or other heirs. And those rules changed slightly as well under the Secure Act. And so we'll talk about that because it dovetails a little bit with the estate and gift tax rules that we also want to make sure that you're taking advantage of in your planning techniques. And so the big tax items this year really fall into the CARES Act. And so when the coronavirus came, really kind of shut down the economy from March on, with that came economic livelihoods of individuals and families and corporations really having to think about where they earn their living, gather their revenues, and how charitable organizations keep providing that triage and ongoing services that they were once providing prior to the coronavirus. And so some of the highlights of that legislation, there were three parts of it, and we're still actually in discussions about additional need because we're, as everybody knows, not out of the woods yet on coronavirus. Increased charitable deductions were expanded during the CARES Act. The ability to use net operating losses and recognize those in this year, also part of that, and also allowing retirement plans that were in the required minimum distribution status a waiver for this year. And that was an interesting technique to take advantage of because you were able to think about what was happening in the market from an asset and pricing perspective, but then also manage your cash flow and income tax circumstances this year by electing to waive that distribution for this year. And again, a waiver, not an extension. And then also allowing tax deferred accounts penalty-free distributions if you were not 59 and a half already and needed to actually look at that source of income to get you through this year. And so we'll kind of start with some of the ideas that, as Dave mentioned, they aren't new ideas really, but what changes in some portfolio ideas is the tax environment you're in that moment, in that year. And that makes doing certain things and making certain decisions different one year to the next. And so one of the things we are always looking at and managing throughout the year at SBSB are, and you've heard this phrase before, tax loss harvesting. And that strategy really involves taking losses through the year and then reinvesting in those same or those like assets after a 30-day wash sale rule to effectively pay a lower tax in the current year, but still participate in your asset allocation and investment market strategies. And so what we're talking about here is adding to that, actually taking capital gains. So intentionally paying capital gains. And the rationale for that is if you're in a lower income tax bracket this year, and while capital gains taxes are lower, and we'll get into what some of the proposals look at for future capital gains taxes, then it might not be a bad idea to go ahead and take gains from some of those assets that have performed really well and you've been holding for a number of years. And then that kind of helps prepare your portfolio for a higher capital gains tax rate in the future. Some of the proposals, and it's really administration agnostic, because we'll be in a need to raise revenue in a lot of different ways, just because of the stimulus that we have been kind of pushing through the economy for the past year and even prior to that. Look at even going to 39.6% for highest income earners. So again, really thinking thoughtfully about your asset mix and the embedded capital gains, and are there opportunities to situate your portfolio and prepare it for higher capital gains tax rates in the future. And
we're seeing a couple different reasons, Karen, why this might be a good opportunity. You've talked already about the tax rates possibly being higher in the future, but also on just looking at 2020 and what your income looks like. You mentioned earlier about required minimum distributions not being taken or being able to be waived for the 2020. And so there are a lot of retirees that have much lower projected taxable incomes in 2020 than they might have had in the past. And so taking gains now can allow you to take advantage of some of your medical deductions or charitable deductions that you already have planned. That's one reason why you might be doing it. We're also seeing a lot of people that have lower incomes, maybe not for the greatest reason, but economic setbacks. Maybe their salary was reduced for a little bit of during the year, or they've had to change jobs. A lot of reasons why your income might be a little bit lower, and it might be a good year to recognize some gains.
Oh, very good points. And the other part of that too is thinking as you're evaluating your asset management strategy, thinking about how you are not focusing assets on high turnover or generating short-term capital gains in the future. And so where you can kind of situate assets to be longer-term holding strategies, that's going to likely serve you very well. But you're exactly right on the uniqueness of 2020 for many, many individuals' income tax brackets, and it helps with what we call bracket management in 2020, especially.
And
Very
remember too that this year's had some interesting opportunities with the market sort of whipsawing up and down and all over the place. And so we've already this year had a lot of capital loss harvesting opportunities, and so there's a chance to take gains not only to offset those losses that were already taken, but above and beyond.
Yeah, that's exactly right. And it helps, like you said, to really think about and coordinate deductions you might actually still be permitted to take under kind of new proposals. There is likely to be, again, some compression in deductions for individuals to continue taking. And so this year it makes really good sense to kind of think about that, time those appropriately so you can take full advantage.
The last thing I'll just mention is a reminder that, because we forget about this sometimes, with capital loss harvesting, there's rules about wash sales, and you can't have the same security, and you have to make sure your 30-day windows, etc. Capital gain harvesting, that's not the case. You can just buy right back into the same security and just reset your basis to the current value.
That's exactly right, and that is a distinction. And I had actually mentioned a little bit about the wash sale rule, but it does not apply to the gains. So thank you for reminding us of that, Dave. And so the other very big area, and this affects majority of the clients that we work with at SBSB, is retirement planning ideas. And there's some other things that dovetail into those strategies with education planning and other unrealized assets that are specific holdings that you can possibly take advantage of recognizing those in this tax year.
That's right. We have listed here on the slides a number of different opportunities, and there are so many different kinds of retirement plans that you have to definitely look at your asset mix of taxable accounts versus deferred accounts versus tax exempt accounts like a Roth, and where it's sitting. But we think that this year is uniquely positioned to give you flexibility. Without the required minimum distribution rules, you don't have to incur a bunch of income with a distribution before you are able to make a Roth rollover, which was the rule in the past. And you also have a flexibility in your brackets, like what Karen was talking about, to look and see what makes the most sense for you. And they passed the rules after we had already had a number of distributions taken in the year, and the IRS really relaxed the rules on rolling funds back into the retirement accounts, both 401ks and IRAs, to give taxpayers a lot of flexibility this year, recognizing the hardships that we're going through.
Yeah, it's worth pointing out that this might be a very interesting year to kind of watch, where there are many opportunities to do a Roth conversion for one of the reasons that, Dave, that you mentioned earlier, in that so many people are affected by the coronavirus and economic kind of deceleration that their incomes are so much lower. And so making that conversion this year, if you believe your income tax brackets will be higher in future years and where asset values are this year, might be a really good strategy for you. and again, kind of measured against your cash flow needs and your other tax liabilities. But given where future tax rates are likely to go, and also lower incomes possibly this year for many folks, I wouldn't be surprised at all, Dave, if we don't see a lot of Roth conversions in the marketplace.
Yeah, I think it's a great opportunity for a lot of people. Now, we've talked about income acceleration, but we also want to point out that depending on your tax situation in the current year, you may want to continue to max out your 401k contributions or your IRA contributions for the year. And in some cases, even the non-deductible IRA contributions, those still can make sense as we talk about tax rates going up, but we have some high tax brackets already. And so we just want to make sure we're thoughtful about that, depending on where you're at in your career and what your income levels will be for the year.
Exactly, and especially those that are kind of younger in their timeline for savings. So time value of money concepts and delaying and deferring taxes still makes a lot of sense. So anything we're saying with prospective tax rate increases still needs to be balanced in your personal timeline, and what makes the most sense for the kind of your goals for growing your retirement assets. So one choice may not be right for someone, but it may very well be right for others.
Now, we've talked about the fluctuating values of the retirement accounts. There's also other accounts that a lot of our clients have that we need to think about fluctuating values. That might be for gift tax purposes or for education accounts.
That's right. That's right. And especially education accounts, this is a really good time to continue contributing to those. It also, with tax law changes under the Secure Act, um, the ability to kind of use some of those 529 plan funds for other kind of private education tuitions in formative years is available to you as well, to kind of help manage cash flow. And we kind of think of those as indirect gifts in a sense, and they reduce your overall kind of balances that you're kind of calculating for estate tax values if producing that is a goal of yours. So.
In a larger tax picture, talking about all the different changes we've had in the last few years on 529 plans, a big change with the Tax Cuts and Jobs Act was allowing $10,000 per year to come out of the 529 for K through 12 education expenses, primary and secondary education. And that's can make a lot of sense, especially if you're in a state where you get a deduction for the contributions in and you're not being limited on that. That's a great tool. And then also in recent legislation was a change that some payments could come out of the 529 plan to pay for student loans for education that's already occurred.
That's
So that's
right.
something to be thinking about.
Yeah, and that's in the newer legislation, but all really great strategies, and especially on the student loan piece, helping a family member or a child kind of sort through cash flow needs where they've been unemployed likely through this year. So all good strategies. And we want to just dig in a tad deeper on the Roth IRA. We talked about that, and just kind of really thinking about one of the things that was eliminated is the ability to create a stretch IRA. And so Roth IRA, making a conversion to a Roth, allows you then to make that Roth a part of your estate plan in still a very tax favored way to your beneficiaries. And so it's another reason. We kind of touched on some of the other reasons regarding prospective tax rates being higher in the future, or valuations on the assets, the underlying assets, lower today by comparison to the future. I think we always like to think about assets growing in the future regardless. These moments in time, we hope they're not long standing in what they do as far as reducing asset values. And so it's a good opportunity to take advantage of that in a Roth conversion as well. And then just a reminder that the distributions are free of income tax, which is one of the wonderful things about a Roth.
And that's for you or your heirs, either one. Yeah, I've always liked Roths for a lot of different reasons. One of them is just what I would call tax account diversification, that we just don't know what's going to happen in the future. And with that uncertainty, diversity really helps you to hedge that. There can be a lot of reasons to put into a tax deferred account, just a traditional IRA or traditional 401k, but a Roth IRA or a Roth 401k option gives you some flexibility to have a little bit in each and to plan for the future or plan for the uncertainty that's ahead. As well, I've always liked, Karen, the benefit if you are subject to estate tax upon passing, if you have a taxable estate, and that even if that's at today's with today's higher exemptions, or if it's after the sunset, if you're subject to those rules, a Roth conversion can allow you to reduce your state by paying tax now on an asset that your heirs will inherit and not owe income tax and a reduced estate tax.
Yeah, we love those. Those of us that really focus a lot on the estate planning part of the financial planning world love those kinds of gifts. They're not gifts that you have to file specific returns for, like using up some of your exemption you do. And so by paying a tax bill on something is a nice freebie.
Yeah, it's your
Mhm.
tax bill, and so it's a freebie. It's not a gift to anybody else, but it does increase the after-tax value of what you're giving to your heirs.
That's right. That's right. And reduces kind of your overall balance sheet today that you're trying to kind of move a little bit lower, or not have to use the exemption to kind of move that lower. And so the next area that kind of is a nice segue into the gift and estate tax planning ideas. And so we've talked a little bit about what the exemptions are, and here's a couple of tables here that you can see today. It's 11.58 million per individual. So for a married couple, that would be double. And the other thing too is that married couple can use the rules and portability rules to take part of some of that unused credit that a deceased spouse didn't use. So those rules are really favorable for married couples. After 2025, as we mentioned, we are now going to look to the 5.4 million, which was the amount in 2017. Now, keep in mind it is indexed for inflation from that period of time. So, by most estimates, the actual credit would look to be somewhere between 6 and 7 million. The rate applied to estates that are over this amount, so today over 11.58 and then in the future over 6 to 7 million, are taxed at a rate of 40%. That's the federal rate. And so we're not even considering here in this slide any state-specific rates, which vary across this country and can put an estate into a taxable rate that's really closer to 50 and even 55% in some cases with a few of our states. And so you can see that the opportunity to take and put a strategy in place to really protect that $11.5 million credit today before legislation kind of intervenes and either accelerates that sunset provision of 2025, or because that is also up for discussion, or reduces it thereafter to even something less than 5 to 7 million, we'll call it. And so there's a number of strategies that make a lot of sense in an environment today where we have low interest rates, we have asset values that are at kind of a moderate place now, and then that can help you actually meet some of your income goals in some cases, and then also meet some of your future beneficiary ideas that you have for sharing those assets into your family. And then also a couple of these ideas look at those that are charitably inclined and whether it makes sense to go ahead and put a charitable trust in place with some of those assets to again be able to take advantage of that credit, but then also get a charitable deduction. The first one here, and many might have heard of this kind of a trust, is it's a grantor retained annuity trust, and then the ideal scenario for that is to assign high growth oriented assets into that trust and with any amount up to your $11.58 million, and you can actually create it in such a way, because the applicable federal rate is so low, that you can zero that out. You can get that valuation to a point, that funding valuation to a mathematical point where you're not now also filing a gift tax return. And so then you're freezing those assets. The other very popular technique, the other strategy too for the charitably inclined, and then this also then moves all the growth of, after the term of this trust, you would set a specific term for the charity to be receiving annuity payments each and every year. And then at the end of that term, all of those assets pass free of gift tax to your beneficiaries. This moment in time where we're looking at a reduced federal rate, which is the one mentioned here, the 75/20 rate, allows you that coupled with where asset values are, allows you a very nice outcome with, again, kind of freezing the assets that you have intended for your beneficiaries. The other idea, and this isn't a new one necessarily, but this year, and also faced with the sunset provision in 2025, is really taking out a life insurance policy that would be owned by a trust, again, not owned by you individually, because that would then make it includable in your estate, thereby kind of taking away one of the really big reasons you want to freeze assets is to not increase your estate. So it's advisable to actually own that inside of a trust where you're not the owner of that trust. But that policy then can, at your death, pay either a future estate tax liability or replace the wealth for the heirs in the form of that trust that would have been reduced by tax outside of your estate. Very, very popular strategy, and especially this year. The other that is something I think a lot of families look to do routinely, but this year is again pretty unique because we're at historically low applicable federal rate, is intrafamily loans. So helping to use those loans to transfer assets to your two family members, to your heirs, at the ultra low rates today. And the interesting thing about intrafamily loans is that some of those balances in those loans can be forgiven. So the interest rate, the interest payment on that can be forgiven by an heir ultimately, and the principal can be forgiven in the form of annual exclusion gifts. And so wanting to mathematically arrive at what that rate number is for you, depending on what you ultimately fund that loan with. And then, of course, making direct gifts of appreciated stock. One of the things, and we'll get into some of the ideas in one of the proposals under a Biden administration, is the step up in basis. And this refers to when an individual dies, the assets that they own now take on a new tax basis that is the value that is as of the date of their death, and not a date that they actually purchased it while they were alive. That tool or technique is being held up as a possible policy change to either repeal that basis, and therefore the family would receive, in that case, a family member would receive those assets in the basis that was carried over prior to death. And so that would be a capital gains tax to the family. And so making a direct gift today could be a way to get the, especially assets that you don't necessarily want to sell today, but maybe sell into the future. The other strategy too that's a great one is a non-grantor trust for a family in an income tax-free state. So now this starts to look at, situating a trust, not necessarily where you live, but a favorable trust, a favorable state where the trust laws dovetail nicely with an income tax-free state in this case. So the trust itself is not paying that additional level of state income tax on the assets of that trust. So it allows you to kind of manage those assets, sell some of those securities with one piece of income tax taken away from it. in the form of the state level tax. And then the other is, again, for a married couple that I mentioned before, where they get double the exemptions here at 23 million and some change, is utilizing a spousal lifetime access trust, known as a SLAT, and that protects some of the exemption. And so being able to create an annuity stream in that trust and kind of hold those assets, and you could use practically speaking, you could use one of the exemptions. This helps in the case where the tax law might move against us with regard to portability. So that's an example. And then also where the exemptions then move down somewhere south of the 11.5 million per person. Also a really excellent technique in keeping it within the family.
We saw on that slide, Karen, there are all kinds of strategies and lots of different flavors of each of those different kinds of trusts, and they can be suited for your situation, changed. Some of them can depend on what state you live in. That can make a big difference on how things are structured. A lot of great ideas in there. This is the estate and gift tax arena is one that's extremely difficult to plan for with the environment we've been in, where it just seems like the laws change every year. And so planning for that, especially for something so far in the future as you're passing or passing on assets to your heirs, can be just extremely difficult. And so having a conversation about your goals and what works best for you is really important.
Yeah, and it really is, because there isn't one right approach for everybody. It's going to be unique. You're typically looking at estates and planning we've done for many of our clients, where it's known, at least mathematically, that they're not going to outlive their assets. They're going to just keep accumulating, and getting ahead of some of those strategies that help them save some of those available exemptions today, knowing that they aren't going to be spending down their assets. And those are ideal scenarios. If you're someone that's really does expect to either break even from a tax perspective or from a cash flow perspective with your wealth picture, then these might be more complex than you need. But they are available, and definitely would want to consult your tax advisors and your attorneys to kind of decide on which particular strategy is right for you to meet your goals. And so the other area that is been very, very unique this year and is in the charitable planning space. And Dave, I think you mentioned also from the IRAs with the distributions. We had this listed in both places because it applies both from the charitable, but it also applies in how to solve for the distributions the required distributions that you have to take, but maybe you don't quite need. From a cash flow or income perspective.
Right. Qualified charitable distributions have been around for a long time. That's for those who are over age 70 and a half are able to send money directly from their IRA account to a charity. And then when you do that, you don't need to recognize the income on your tax return. You also don't get the deduction, but it usually ends up being a better answer as you combine some of the limitations on Schedule A of your tax return and the deductions available there, or trying to decide between itemized and standard deduction. Doing a QCD it can be a great option.
That's right, and we work with many of our clients in doing that annually, regardless of COVID. The year we're in this year with unique charitable planning. One of the things that I mentioned on the trust and estate planning side is funding a charitable lead annuity trust, a CLAT. And this kind of lives here in the charitable planning space as well. But being able to give a gift today, an annuity where a charity is, again, this is for the charitably inclined, where a charity has been, that's near and dear to you, that has been struggling this year due to COVID, isn't a bad idea if you already are planning on passing some of the future asset appreciation to your heirs. You can take advantage of low income tax rates today and low applicable federal rate tax for that calculation in funding that trust, and help the charity that you have been helping all along, and that may be a structure to help them more continuously year over year as we work through the pandemic. The other is, and within the CARES Act, this year and specifically is the ability to take basically 100% of a cash gift to a charity, and be able to take that against your AGI this year, or sorry, take that tax deduction this year. And what's interesting about accelerating, there's many clients we've worked with that have pledges. They've made long-term gift pledges out to their a charity that they're very, very intimately involved with, and they've made a long-term pledge. Well, now there's an opportunity, perhaps you're not stretching that pledge out over a number of years. You could accelerate some of that pledge depending on what your AGI is today. And so that's a strategy that could be helpful to many donors who are in higher income tax brackets.
You mentioned the higher AGI limitations that came about in the CARES Act. Just to clarify, that is for cash donations only. So you do have to plan around those higher AGI limitations carefully, but that could be a great opportunity. Another really small item that was in the CARES Act is that for taxpayers who are taking the standard deduction, there's a very small additional deduction you can take for charitable gifts for $300 to add to your standard deduction. So it gives opportunity for everybody to benefit from giving to charity, even if it's just a little bit to help out during this time. So there's a couple interesting changes that come about recently. And Karen, you were talking about giving appreciated stock, and what a great opportunity that can be to not recognize the gain, but to take a deduction for the full fair market value of the stock that you give, and gives a lot of flexibility. We have listed on here donor advised funds. This just goes in line with a lot of things that we talk about of any area that we're planning in. We like simple solutions that are very, very flexible, and a donor advised fund is a perfect example of that. It allows you to give in the tax year that makes the most sense for your situation, but then to benefit charities when you would like to, or when they need it, or when you want to give, and also use those assets to continue to grow and benefit charities in the future. And so donor advised funds are something we often recommend, as it gives that flexibility and the ability to accomplish your goals. And we have listed here on the slide that really what I like to refer to, Karen, is it's a real technical term in the tax world of bunching your deductions. If you have very few deductions in one year, and you take the standard deduction that year, and the next year you bunch all of your deductions into that tax year and take the itemized deductions, usually across the 2 years you can realize a benefit. And so donor advised funds help you accomplish that.
That's right. And also I love donor advised funds for a lot of the kind of tax bracket management we talked about earlier, Dave, and folks that are expecting, big bonuses in one year, or accelerating certain income events in a certain year. It may not even be this year, but maybe we're looking into 2021. That, coupled with a higher tax rate, this is an excellent strategy, and quite simple to put in place, especially when you consider it against many others that are for the charitably inclined. It can get complex pretty quickly, but donor advised funds keep it simple for everybody.
And they're really great, as you mentioned, in a year maybe right before retirement, when you might have high income, but you don't expect that in the future years. That's
exactly right. And so in the next, I think you had just mentioned this on the limitation. Specifically, the limitation for charitable deductions was suspended for this year under the CARES Act. And like you had mentioned, it's for cash contributions, of course. But I wanted to just kind of pull this conversation in here about just the nonprofit sector. I think people don't appreciate sometimes how much of the sector makes up of our GDP, but it makes up, and this is an older figure even, and the new figures are being updated for 2018. This one kind of ends up rotating every couple of years, but it's 6% of GDP. So it's a sector that employs, more than 12 million employees. And so all of these strategies, you're helping on both the employee side, but then also on the donor program, on the programming side as well. And so again, really looking at some of these charitable strategies for 2020 specifically is a great idea. The other thing too with the CARES Act I do want to call out is the contribution to the donor advised funds are not eligible. And that really goes back to what Dave, you just mentioned with regard to donor advised funds. One of the key advantages is the reason it's ineligible under the CARES Act is that you're actually taking a tax deduction for funding that strategy in the tax year you're funding it, but you're not required to pay it out in that tax year to a charity. And the whole point of the CARES Act is really to come in and triage and help the kind of economic stress that this community is experiencing. And a donor advised fund, that aspect of it doesn't quite accomplish that second goal. And so it was excluded from the CARES Act for that reason.
You can still make contributions to the donor advised fund in 2020. They just aren't eligible for the increased AGI limitation.
And that's exactly right. And so we'll kind of wrap up with a little crystal ball. Just kidding. But I put on that slide a Biden presidency. What does that look like? And so we're not here to kind of give an opinion about or a preference of. What we think about is, what has policymakers up at night? What are the things that will be implemented that affect the goals that our clients specifically are trying to achieve? Many are financial goals, some are non-financial goals, but obviously we are in a year where we've increased the deficit to such a level, and you can see here on this chart, there's a table here of the pre and post-crisis budget projections, and that is why when you look at the proposals, the tax policy proposals by Trump or by Biden, many areas are looking at increases across the board. Whether any or all of those increases take effect, time will tell. But what we do know is there's probably some low-hanging fruit there, I like to say, especially in the estate and gift tax exemption and rates. Those already have a target date that we've been talking about, the sunset date of 2025. So there's a lot of room there to accelerate that, bring that amount lower. Individual income and capital gains tax rates. Looking at those, we have really favorable long-term capital gains tax rates in this country, and so that's also being looked at as a revenue source. And then corporate income tax rates, moving up a few percentage points, and those, and there's many other areas, but these three in particular have proposals that are getting a lot of traction in the policy community, because like I kind of call it, there's some low-hanging fruit there that would probably gain bipartisan support, and that's why, as we talked through the presentation, you see scenarios that we are addressing that kind of help you think about what 2021 could look like or 2022 could look like in an increased tax environment, both capital gains and marginal income tax rates. We put here on this slide, just to the left is the, I think, more simplistic view of what some of those proposals look like. So for example, moving marginal rates up to 39.6, the top bracket up to 39.6%, capital gains, keeping that at the same for those that earn more than $1 million in income per year. And so far the interpretation is married filing jointly. And then removing that step up in basis at death, something I talked about in the estate planning slides. And that indirectly then beneficiaries are taking that tax burden and paying that when they sell those assets. And then the interesting thing that's getting a lot of attention right now is on Social Security and what the modified tax could look like on that. And the proposals right now look at, you know, coming in at another hurdle of 400,000 in income and applying every dollar earned after that point, another tax of about just over 12% is what's proposed on earnings over 400,000. So you'd have this gap between what we're already paying on our wages at 130, approximately 130,000, and then in between until you get to 400,000, there would be no Social Security tax calculated, just like we have today, then introducing it after 400,000. And then Dave talked about itemized deductions and really thinking about 2020 as a way to kind of think about what can you take by, you know, taking recognizing certain income this year in 2020 so that you can take advantage of certain deductions like medical deductions and the like. And then the phase out of the qualified small business income deduction, again, over 400,000. So what continues to get some kind of traction is this number of 400,000 is being kind of pulled in across the board in a lot of different ways. That is, you know, arguably people have opinions about whether that's the right number, of course, and where you live and where you're situated changes that answer. So not all states that carry the same cost of living. And so that'll continue to be debated. But our goal is to kind of highlight what some of the impact could be to you personally for your financial planning.
You've got a lot on this slide, Karen, and as you said, crystal ball, it's hard to tell what the future will hold. You know, looking on the flip side, Trump has not said a lot about what he'd like for the future, except that he'd like taxes to go down. He says tax cuts. He's also highlighted that the Tax Cuts and Jobs Act, which was enacted in 2017 and which he's really trumpeted as a great achievement of his presidency, he'd like to make those numbers permanent, and a lot of the provisions permanent as it could be in a country that has changing Congress all the time. But he'd like those to continue in the future. So that's sort of what he has said. And then Biden has, as you mentioned here, a number of proposals. Some of these have been uniquely his. Some have been adopted from other proposals that have been made not only during the run for presidency, but some of them going back 8-10 years. These are topics that have been talked about over and over and over again. And as you said, some of them are seeming to become a little bit more likely. Some of the ones that I think are especially important to look at when you're looking at the future and trying to plan for the next couple of years is the Social Security tax. That's quite a high rate that will impact any high income earners. Again, that's wages over 400,000 will have the Social Security tax put in place before there was a ceiling, and that'll come back. I think that's an important one to look at.
Yeah, that's exactly the one that has has my attention, simply because it could help. It might introduce strategies that restructure how someone characterizes wages, and especially those that could move off of, we'll say, traditional W-2 earnings. So that'll be interesting because it'll invite some new strategies. But Social Security reform has been discussed in every administrative cycle. Every candidate has addressed it. There's plenty of data that support kind of how that particular funding source is not sustainable in its current format. And so I think it'll continue to be discussed. I don't, again, no crystal ball here. We don't know where it lands, but I do think that it would be really interesting to see the strategies evolve if there is a tax on the over 400,000 in income.
Right. And yeah, it'll just be interesting to see. And I think on each of these proposals, we probably all have our own opinions on whether it's a good idea or not a good idea. Some of them have, as you said, been talked about for a long time, and they're in areas we need solutions. And so it's possible that even under a Trump presidency, we could see increases purely because of the reasons from your last slide about the percentage of GDP that the deficit or the
That's right.
debt burden is. I find it interesting that Biden proposes going back to 39.6% as the highest marginal rate. That was the rate in place before the Tax Cuts and Jobs Act. I'm not sure what's so special about that number, but that seems to be a big one. Uh, I think that capital gains definitely are under, all the ones you've got here
Yeah,
are on the table. The step up in basis is one that's been talked about. They have a couple thoughts. They could either not allow a step-up basis, which would have a carryover basis, usually at a decreased value, or they could have a tax at death, an income tax triggered that allows you to step up basis, but requires the beneficiaries to pay income tax. I really think that on the estate tax side, although there's very likely to be changes there, it'll be interesting to see how they balance the need for revenue with what I would call administrative reasons. The higher exemption amounts really make it so much easier for the IRS and for everybody, all taxpayers, all of us. It just makes things simpler, and so they'll have to balance those two things. You didn't
yeah,
mention, Karen, the last thing I'll say, that these are all on the federal side. A lot of states are hurting on the budget side as well, and we're starting to see some proposals coming out of the state side that it's not really going to be an election that decides its fate. California, for example, has proposed a number of taxes that will radically change taxation of Californians, and a number of other states are looking at that as well. And so there's a lot of uncertainty for the future that we're just trying to plan for.
that's exactly right. Yeah, we're looking at, even, prior to COVID and the CARES Act, we were already nearing 100% of debt to GDP, and now we're closer to 155, 160%. And so, for exactly those reasons, whomever is elected will be looking at places that can get bipartisan support and move through for some tax increases. But California is a big one, proposing right now, a wealth tax, and it's inviting a lot of conversation by corporations that are headquartered there, that hire key employees that are really, seven-figure employees. So it all has some impact, and really, is, if anything, should have you pause for a minute on what your planning looks like. Reach out to us with any planning questions about this presentation that you think could be helpful to you. And then also, where you have state-specific questions. We largely stayed out of the state conversation here. Our clients live all over the country and in a variety of states, some tax, some not. And so we will happily work with you through those issues as well. So we thank you for joining us, and hope you find the presentation useful. And we'll reach out to your relationship managers and team for any follow-up.